Welcome to Prescribing Prosperity with your hosts, John and Alex Soutsos from MedWealth Financial Services, operating through IPC Securities Corporation. In this podcast, we provide unique insights into wealth management, the psychology of financial decisions, and help listeners place the capital markets into perspective. Our aim is to help physicians, business owners, and other medical professionals to live their dream. Life is to live and enjoy, so we'll also cover health and lifestyle-related topics such as food, dining, travel, and unique experiences. Learn how global trends shape our investment strategy as we help you assemble your roadmap to prosperity.
Hello and welcome to the Prescribing Prosperity podcast with your hosts, John and Alex Soutsos. Guys, this is part 2 of a really interesting series that we're doing here in terms of navigating the risk on the road to retirement. So it's good to be back with you again. John, Alex, how y'all doing?
Doing very well, Bill. Thank you.
Yeah.
Doing great, Bill. Thanks for having us.
You know, we were talking about all these navigating these risks. And when we broke off, we had been talking about in the last episode about all the various biases and the kinds of things that influence people's decisions about how they construct their portfolios and what they think make good portfolios and how they won't admit that they've made a mistake in constructing their portfolios. We left off on the idea of familiarity bias. So why don't we pick up there, John, in terms of just what is it? I mean, is it that we just gravitate toward the things that we know and avoid the things we don't know, or is it more complicated?
It's interesting, Bill. My wife spent her third year of university a long time ago in France. And she spent some time in Paris during that period. And one of her observations were about American tourists in France. They would go there and they would order American food. You're in the culinary capital of the world and you're ordering and you're looking for hamburgers.
Oh God, that's no good. That's not good.
Right. So that's an example of familiarity bias. We're creatures of habit. That's our nature as human beings. And so we want to do the same thing over and over again. And when it comes to investing, we're most comfortable with businesses that we're familiar with. So here in Canada, one of the most familiar companies that people invest in is Bell Canada. And as you know, in the U.S., there was Ma Bell and AT&T, et cetera.
Yeah.
A number of years ago, actually, it's longer than I'd like to admit. It's now, what are we now? 2024. I can't believe it's 2024. Back in 2001, I had a client who was an engineer, a German engineer. Aren't all engineers German? A German engineer who worked at one of Canada's largest companies called Bombardier.
Oh, I know Bombardier. Yeah.
Yeah, they make planes, trains, and snowmobiles.
A large industrial company. They also make subway cars, by the way.
That's right. That's right. I said trains, didn't I?
Yeah.
So anyway, he came in. He was a referral from another client. He came in. I reviewed his portfolio, and I said, and he was in his late 50s at the time. I said, well, this is very interesting. I said, you have a little bit of money in a bunch of mutual funds, but 80% of your money is in Bombardier stock. I said, aren't you a little uncomfortable with that? I said, no. He replied, no. I said, now Bombardier may be a very good company. They may be a great company, but it is my experience that it is imprudent to have 80% of your money with any company, regardless of how good they are, because you just don't know at any point in time what can happen.
But you don't know. And I mean, I will go to this point. I know who Bombardier is, but I have not heard any news about Bombardier.
There's a good reason.
Some time, yeah.
There's a good reason. So I reviewed the portfolio. I said, my recommendation to you is, before I gave a recommendation, I said, what is your objective? I said, how much more does your portfolio need to increase in value before you feel comfortable enough that you can either retire or semi-retire? And he said to me, well, 10 to 15%. I said, well, 10 to 15% is not a lot of money, is not a big rate of return. You don't need to be concentrated in a single stock. You can do that with a mutual fund, which is more diversified. And he said, well, listen, young man. And again, he did the bring the reading glasses down to the bottom of the nose, look over top in a stern manner, and said to me, young man, I am an executive with this company. I see the order book. On my desk rests a computer. It's 2001. So this is before all the technology we had today. But I have a computer. In the bottom right-hand corner of that computer screen, we have the ticker symbol for Bombardier live. And if I want, with a couple of keystrokes, I'm in or I'm out. So I don't need to worry about Bombardier stock. I said that may very well be true, but what if you need to go to the bathroom and something happens while you're in the bathroom? I said, stuff happens quick in the markets. I said, oh, how about when you're on vacation? You're going to lug along your computer. This is in the early days of BlackBerry, and when very few people had a computer in their pocket. I said, you're going to lug around your computer on your vacation? He said, he didn't say anything. I said, the truth is sometimes you're not in a position to react, or you just simply cannot react quickly enough because markets move very fast.
Right.
And he shook his head. He said, don't worry about it. I'm fine with Bombardier. Fine.
Wow.
So anyway, a number of months go by, and we're scheduled for another meeting in the future. And then it's a crisp, clear autumn morning in New York City in 2001 when a dramatic event takes place that changed the path of human existence.
Yep.
And it happened before the market opened.
Yes,
and the market did not open on 9/11.
No, it didn't.
It remained closed. And we all remember where we were on that day. And it was just recalling the event. It's quite emotional because I remember how I felt when I saw the events unfold on television. But the market never opened on that day. And there was an order to ground all airplanes, if you recall.
Mm-hmm. Yes, I do.
So I remember the unusual, eerie feeling in the ensuing days as you walk around outside or drive around the car, and there was something different. And it was the fact that there were no airplanes in the sky. They're a common sight, as we know, in everyday life. There's airplanes in the horizon going back and forth.
Yeah.
And or on occasion you hear the loud streak of the jet, and it was eerily quiet for a good week. Bombardier stock was trading somewhere around $20 a share at that time, and the market. So that was on a Tuesday. The market did not reopen until the following Monday. And when the market reopened, the stock market gapped down. And for those who are uninitiated, gapping down means there's a gap between the last trade of the previous day and the first trade of the current day. It's just air. There's nothing there. No in-between prices.
Oh,
so
yeah.
Bombardier gapped down from something along the lines of it went from $20 a share to something like $13 a share. So basically lost 1/3 of its value in a single moment. 1/3 of its value, which is remarkable. So, and the market as a whole, I think, declined 7% on the open. I'm going from memory now, it could be different. Anyway, a couple of months went by, and this client was due to come back to my office for a review. And I was a significantly younger person back then. Obviously, we're talking about 23 years ago. And I was raised in a household where you respect people older than you. And I did not want to say anything insulting or derogatory to the man.
Mhm.
So he came into my office and he sat across from me, and I just kind of took a deep breath. And I said, well, what are you going to do with Bombardier? Now, by this point, it had come up a bit to about $14 a share. And he looked down, he looked back up at me. He said, well, I think I'll wait till it goes up till $16 or $17 a share, and I might consider selling a portion of it then. I said, hang on a second. What leads you to believe that the next $2 to $3 per share move in Bombardier is going to be up and not down? At which point he got agitated. And
Yeah.
once again, he leaned over top of my desk, pulled his reading glasses down to the tip of his nose, and in a stern voice said, surely to goodness, young man, this company was trading at $24 a share not long ago. In time, it'll trade at $24 a share again. And I shook my head. I said, have you ever heard of Polaroid?
Oh, good example. Good example. Wow.
Polaroid peaked, I think it was in 1972. And from 1972 to 2001, never saw that peak price again. And where are they today? So with that, I said, you really need to consider liquidating Bombardier and putting your money in somewhere more diversified. This is just after the 9/11 events. A number of months go by. As a matter of fact, it was probably, so I think I saw him in January of 2002. So 7, 8 months go by. We're in August of 2002. And I'm driving into the office and I'm listening to the business news. And I think it was United Airways announced a bankruptcy.
US Airways.
It was US Airways?
Yes.
US Airways announced a bankruptcy. And I thought, oh no, there goes Bombardier. So got into the office, put on the computer, and of course, Bombardier had since just tanked to $2 a share. After
Ooh.
peaking at $24 a share, it was now $2 a share. So this man had lost 90% of his retirement plan through familiarity bias because he wanted to own shares of the company he worked for that he probably cared about, and which is understandable. It's an emotional thing, but it just speaks to the dangers of familiarity bias. And in the United States, of course, we have the employees of WorldCom and Enron, who unfortunately went through the same experience for different reasons.
Sure. Yeah.
Right. Now you give your employer your labor capital. You don't need to give them your financial capital. And if you want to hold a little bit, a token amount, nothing wrong with that. But to invest the majority of your financial assets either in your employer stock or in some company that you're very familiar with, like Bell or AT&T in the States, or you name the company, it's just very dangerous.
Yeah. You know what? I'm going to compliment that story with a really, really quick one of my own. I worked for a company at one point and held options in the company, as did other people. And a guy I worked with had a decent amount of options, and it was announced that we were going to be taken over. I did not cash in my options that day.
Uh-oh.
He did. He cashed in his options and retired to a leisurely life, literally running a drawbridge down in Delaware and enjoying himself and getting a cup of coffee every morning and talking to the people who wanted to cross the bridge. And I continued on.
And here you are.
At my desk, and here I am today. Yeah, exactly. No, I understand familiarity bias really, really well. And it sets us up, I guess, in a way, and you know, I'm tempted to go into the media, the biases created by media, but I'm going to skip that for a second because it raises a question in my mind in terms of navigating these risks. You have those kinds of stories, and they're very real, and believe me, they have an emotional value to people. So how do you get around, guys, to like creating a sort of winning mentality that's necessary, I suspect, for building a portfolio that's going to carry you? How do you do that?
Well, you drip on people and you educate them. And now I write a newsletter every week. And my newsletter is a weekly roundup of what happened in the preceding week in the financial markets. However, I always begin the newsletter with a quote to put things into perspective. And I usually write a lesson, an investment lesson to be had.
Mm-hmm.
And so the subject matter we're discussing today, I cover bits and pieces of it every week to try and educate people. And it takes time. No one's going to respond to you just because you told them one incident, or because you said, I'm telling you this and I'm a professional and you should listen to me. No one's going to respond to you. People are people. We're human beings.
Yeah.
We have emotions. It takes time to make change. And so this brings me to the topic of, and I don't know if we're out of order here, but to faded blue chip stocks. So here in Canada, we have our collection of blue chip stocks. When I was a young guy and I worked at the bank for a couple of years, I used to remember being at the counter and these wealthy looking women coming in, we're all dolled up, and they bring in their dividend checks from the widow and orphan stocks, which in Canada included Bell Canada,
Sure.
among other companies, and other blue chip stocks. And I was really impressed by that these people had every month they'd show up with a different array of dividend checks, and they looked very well to do. And I thought, wow, I'd like to be part of that someday. Anyway, so fast forward to today, I have a few clients who are near my age and are of that era, that they had an emotional attachment to certain companies like Bell, or like another fixed line cable company here in Canada named Rogers, and some other companies, some insurance companies who historically were surefire companies. But as you know, the world evolves, and a lot of people are cutting the cord on cable. But the government, the regulators, don't change so rapidly. And so a lot of these legacy organizations are being handcuffed by regulations and the inability to compete. And so they have really faded. And so I pointed out to a few clients that I know that own shares in some of these companies. Oh, the other company I'm thinking about is Canadian Tire. And Canadian Tire, what would you think, Alexander, the
Dick's
U.S.
Sporting Goods.
Dick's Sporting Goods would be the equivalent?
Correct.
But Dick's Sporting Goods doesn't have automobile parts?
No, it's kind of a blend. It's a hybrid between like Dick's Sporting Goods and Walmart, essentially.
Yeah. So
fair point. Yeah, it's well said.
Yeah. So Canadian Tire is one of these companies, and so I've been tracking these things for a long time, and I noticed on my regular surveillance of these companies that they've done nothing for 7 years. So anyone who's held these shares, including dividends being reinvested, they've had effectively a return on the magnitude per year of roughly 2% a year. So essentially nothing. And when you factor in inflation, they're probably negative.
Wow.
And so I had a review with one of my clients who I know hold these, and I've been dripping on them for years that they got to get rid of this company. And they finally, with the perspective of a graph and with a context of comparing it to our model portfolio, which is better structured. And I said, here's how our model portfolio is done over 7 years. Here's how your faded blue chips have done over the last 7 years. And they relented and agreed, you're right, it's time to make the change. And so we're in the process of doing that. But there's a lot of people who've held stocks in their people who still have stock certificates. Right now there's a couple of stock certificates sitting in the safekeeping and at my office waiting for me to go in and to arrange for liquidation. And that's how long they've had these stocks. From the time period when the certificates were actually printed. Okay, so you can't hang on to these things. You have to be current, and this is again the importance of having a professional working with you.
Well, yeah, but you know what? Go ahead, Alex. I'm sorry.
Sorry, I was just gonna jump in there, Bill, and just add to that and say I think people also tend to get enamored with the dividend yield of some of these older companies, and they get hung up on generating a dividend yield. And dividends are fine, and there's nothing wrong with a dividend, a company that returns capital to the shareholders. However, the dividend yield is only one component of the investment return. You have to look at the
Exactly.
total investment return, not just the dividend yield. And that's where I think a lot of people end up becoming short-sighted in an effort to try and get those dividends, which are great, and they provide you with some liquidity and some income. You are sacrificing an opportunity to make a higher total return with other investments, and the total return is what matters. It's the change in price as well as the dividend yield, which comprise the total return, and that's where the true value lies.
So here's the question, because and look, and I'll admit some emotional bias and intellectual bias on my part. It's hard, John, like your clients who've held a stock for a long time. It's how do you convince people that, look, I actually know what I'm talking about. and you have your money with me, and you should use me as your counsel. You should listen to me. I mean, I think it's hard for people to say, okay, fine, and yield to that. I mean,
Well, they perceive that as a conflict of interest, because they think, well, you're just telling me that because you want more money to manage. And yes, we do want more money to manage, but we also are professionals and know how to construct portfolios.
Yeah.
And most people don't have a clue as to how to construct portfolios properly. But one of the other things we do to try and help people understand this, develop a winning mentality.
Mm-hmm.
There was a study conducted in 2016 that found that after adjusting for nearly 50 socioeconomic and attitudinal differences, investors with advice were found to accumulate roughly 3.9 times more assets after 15 years.
Wow.
Compared to people that are not using advisors.
Wow.
And that's all about the behavioral gap that Dalbar has talked about. And to demonstrate why even the wealthiest and most accomplished individuals still pursue third-party help, let's take a look at LeBron James. He pays approximately 4% of his annual income to have the best training and fitness preparation available to ensure that he can perform at his peak. If LeBron James, or you substitute whatever professional athlete you want, is prepared to give up that percentage of his income to get proper advice and guidance, why wouldn't you?
Good point. Very, very good point. Yeah. Okay. So we'll start calling you and John and Alex investment coaches.
Yes.
Oh, it's very true.
Maybe that makes it better.
Yeah.
Coaches and guidance counselors sometimes, Bill.
Well, listen, sometimes I need a guidance counselor. I'm not going to lie about that.
You have our number, Bill. Oh, sorry, you're in the States.
I do. That's right. I'm in the States.
We're not licensed. You can still call us. That's right.
So this takes us to a point in terms of portfolio construction. And I've been witness to this over my career. Okay. When I started covering business and financial news, nobody could construct their own portfolio really, unless you were extraordinarily wealthy. You went to, E.F. Hutton. Remember them, John?
Oh yeah.
You went somebody, you put your money in an investment.
When he speaks, people listen.
Yeah, good. When E.F. Hutton speaks, people listen. But but you didn't have the ability to craft a portfolio. Then the advent of technology and the access to trading platforms and everything allowed us to start creating our own platform, or allowed us to start doing our own, if you will, do-it-yourself investment platform.
Metaphorically, Bill, the industry handed us a knife so we can cut our own throats.
Yeah, well, but some people didn't. Some people have done well with that.
Some people just got injured.
Yeah, and some people just got injured,
Stitches and you're good.
Why do you think the appetite's there? I mean, because it is true. A lot of people have gotten injured by it. Yes. Why do you think that that's been so prevalent and been such a difficult trend to fight?
Well, I think there's a couple of different reasons, Bill. The primary reason is there's been a race to the bottom when it comes to fees, either through low cost advisor platforms or discretionary do-it-yourself platforms, because the industry has become largely commoditized. As we documented in the previous episode, there's very little creativity which exists in the portfolio construction that occurs at large institutions, whether it be at the banks or independent financial institutions. Everything tends to be largely homogenous. You go to you go to one institution, you fill out the same survey, 90% of the people score balanced portfolio, and they have hundreds of different holdings in that portfolio. And like my dad mentioned, there's going to be an allocation to the United States, to Canada if you live in Canada, otherwise in the world nobody cares about Canada. Europe, maybe some emerging markets, and then obviously a fixed income component. And they're all more or less the same. So I actually, when I was working on one of our presentations, went through and opened up a couple of these and started digging through their filings in order to see what they were holding. And you compare the two and you put it on a spreadsheet and you'd think, holy cow, it's the same bloody thing. They're all investing in the same companies. They're investing, one has 500 different companies. The other one is, 700 different companies. They're fund to fund investments, and then they slap on a big fee, and people look at it and they say, well, what the heck? I can do that myself. And so there's a bit of an appetite for it there. And so the only way that these companies can differentiate themselves is to cut costs. And the other issue is when it comes to people who don't have a lot of money to invest. Unfortunately, in the industry, it's not, you can be one of two things. You can be a high quality service provider where you deal with a small number of very large individuals, or you can be the Walmart and you survive on volume. But you can't give very good advice when you're providing high quality, when you're just going after volume. And so for the people who are at the smaller end of the economic scale, they do not necessarily warrant the interest from the high quality advisors. They end up in the commoditized institutions. They say, well, why am I going to bother doing it with them? I can, make a run of it myself on my own. And so that's where the appetite for these solutions comes from. The problem is that, as I mentioned, or as my dad mentioned as well, a lot of people, because they suffer from emotional biases and a lack of objectivity, do not manage these portfolios to their own best interest and are unable to achieve are unable to achieve the financial goals that they set out for themselves. And it's the same thing when they go to the institutions. They're going to end up with a largely mediocre portfolio that's going to maybe barely scrape by and beat inflation and match or hover around the benchmark, but it's not going to make a meaningful difference on their long-term retirement capital that they need to accumulate. And so the solution is you want something that has the opportunity to provide you with enough capital in retirement to be able to sustain you over that period of time. I don't think, and we're going to get into this a little bit later, but I don't think people really fully appreciate how long retirement is. In many cases, it can be almost as long as your working career. And so you have to think, I have to have enough money without working to be able to sustain my standard of living.
Yeah.
And so people worry about diversification. That's why all these institutions have these portfolios that are diversified 9 ways from Sunday, and it's because they want to reduce risk or volatility. And the truth of the matter is you can achieve sufficient diversification with 20 to 30 holdings. After 20 to 30 holdings, the incremental benefit that you get from adding an additional holding is marginal. But what you do is you end up reducing your rate of return potential because it becomes this giant bloated portfolio that does not have enough lift to be able to generate sufficient return. I always give the example of a plane. You can fly a cargo plane. It's going to be big, heavy, it carry a lot of stuff in it.
Yeah.
But it's not going to get to a high altitude and it's going to go at a relatively slow, steady pace. Or you can fly a fighter jet, which can go to higher altitudes and break the sound barrier. But it's going to be a bit of a bumpier ride. But you got to decide, what do you need for your retirement goals in order to be able to achieve the rate of return that's required in order to meet those goals. Dad, anything to add to that?
Yes. When I used to give that example, I used to say you could get a Cadillac that gives you a soft, cushy ride, or you can get a Ferrari and go really fast. And I see my son has taken it to the next level, and we're now in the air. So who knows? Maybe my grandson, Robbie, will be using a similar example. And you can say, you can use a fighter jet with an old creaky thing, or you can use SpaceX
There you
and
go.
go 10 times faster. So yeah, great analogy, Alexander. You one up me on my Cadillac and Ferrari.
There you
I'm
go.
not sure how many people still know what a Cadillac is, but
Cadillacs are nice cars, though. I think you'd have to go with
still
Hey, be careful, because you're treading on personal ground here. My dad, who's passed, but he spent the last 15 years of his life selling Cadillacs, and in fact was one of the top Cadillac salesmen in the country.
so you
see,
know
I like Cadillacs. Oldsmobile, Dad. Let's throw Oldsmobile under the bus. They don't-
Oldsmobile. They don't even exist
It's just
anymore.
a soft-
Exactly.
There you go. There's a plate that nobody's come from. But the thing is, I think a lot of people, and like myself, look at these companies. And you're right, Alex. I recognize from my position in reporting on the industry for a long time, it's been a race to the bottom in terms of fees. It's been hard, and so they end up offering cookie cutter solutions. And people look at those cookie cutter solutions, and I think they're kind of put off by them, because it feels like, oh, this is a one size fits all sort of solution. So
Yeah.
the question becomes, what are the alternatives? I mean, surely not every financial advisor.
Well,
says,
Bill,
cookie.
the truth is people have not clued in. So we're discussing it here, and it seems so obvious to us, but Alexander and I are in the business. To the average person out there, these cookie cutter all-in-one solutions, they think this is great because they're dealing with a bank that they dislike but trust. Their family are in similar portfolios. Their friends are in similar portfolios. Their colleagues are in similar portfolios. Here in Canada, the medical doctors have an organization they tend to deal with uniformly. And, if Dr. Bill is in this, then it must be good. And so the herd mentality continues. People have not clued in. So what we are doing systematically is we're going out to the public, and we're getting people's attention, and we're pointing out to the fact that things have to change, and you got to do things differently, because those cookie cutter solutions are based on mitigating volatility and keeping you happy and comfortable, but these things are not going to meet your goals. And what we're advocating for is a goals-based approach to investing. Where do you need to be in 5 years, 10 years, 20 years? How much money do you need to have? What do we need to do now in terms of your participation? How much money do you need to save systematically to get to your goal? At what rate of return, and what kind of rate of return can we provide? It depends on the asset mix of the portfolio. So whereas most people are scoring balance and getting middle of the road portfolios are going to get a 4 to 6% annual return, but they actually need a 12% return to get to their objectives, then we have a gap here that needs to be made up. And so the investor needs to decide, do I want to feel comfy, cozy with my blankie, or do I want to get to my destination? And, imagine if I said to you, well, you got to be in Paris tomorrow. And you prefer riding on boats instead of airplanes. Well, you're not going to get to Paris on a boat, at least not in one day. Right. It's going to take you at least a week. But if you get on an airplane, you can be there in 5 hours. Yeah. So
sometimes you Concorde over here.
So you have to,
Alex. Come on.
Oh, you got to be lead-footed or lead-handed.
Yeah, exactly.
Push on those thrusters. Anyway, so the point is, holding an all-equity portfolio is not necessarily a risky venture. The prices might go up and down more frequently and to a greater magnitude. But if you have a high-quality constructed portfolio, you're not going to lose your money unless you panic at the wrong time and sell out. Right. But if you leave the professional to do their job, and they're a proven professional that have demonstrated capability, then they're going to get you to your goal on time.
Well, this goes to your point that you made in the last episode, which is volatility is a factor. It's not a risk.
Correct.
Yeah. And if I could just jump in for a second here, when it comes to to portfolio construction. As my dad mentioned, you can go with an entirely equity-based portfolio, but you can still incorporate defense if you want to by investing in companies which are defensive in nature. But they still, because they are equities, you're still buying ownership shares. They still have a higher rate of return potential than investing in fixed income instruments, which, although they usually reduce volatility, that's not always the case, as we saw in the last 2 years, where fixed income got absolutely crushed because interest rates were
Well, yeah,
increasing.
no. Yeah, there are a lot of people who are probably listening to this thinking 2021, I remember everything kind of got crushed and it was awful.
Yeah.
And then 2022 was the first time in a long time, actually, where we saw the quote unquote balanced portfolio perform like it maybe ought to.
Shift forward 1 year, Bill. There's 22 that got crushed. 23.
Oh,
was
yeah,
the
I'm
first
sorry.
year.
Yes, you're absolutely right.
My-
I
yeah.
apologize. You were
But
absolutely right, John.
regardless,
Yeah.
a 15% decline in fixed income rate of return in 2023. And, that's not, obviously that's an outlier, but still, the point being, it's there to reduce volatility. And in one of the most volatile markets we've experienced in the last 30 years, it did not do its job. So hold on, Dad, before you jump in, one thing I just wanted to give as an example, if somebody who is looking to get into if somebody was looking to go into a goals-based approach versus a volatility-based approach, is, let's say you have a household income of $200,000 and you want to maintain that standard of living in retirement. So using the 4% rule, which is an actuarial number, I didn't just pull it out of my rear end, the 4% rate of, or 4% drawdown, you would need approximately an asset base of $5 million in order to sustain your standard of living without encroaching upon your capital. So if you currently only have $2 million in assets and you plan to retire in 10 years, that means you need an average annual rate of return of 10% to ensure that you get to your goal of $5 million by the time you retire. And going back to what my dad said, if you are just going based on a volatility-based approach that has an expected rate of return of 6%, by the time you're 10 years down the road, you're not going to be where you need to be. And so you either have to make one of two decisions. You either got to work for longer, or you got to take a step down in your standard of living. That's it.
So just a bit of clarification on that point. It's not an issue of encroaching on capital. It's an issue of permanent capital depletion, the 4% rule.
Sorry.
Just want to make that actuarial correction. What I wanted to say earlier when I interrupted was, and this is the illustration I like to give people on the concept of an all equity portfolio, but using defensive stocks. And what I'm about to say here is not an investment recommendation, so don't go running out and buying this company, because circumstances are always evolving.
But you're using it to talk about an example.
Exactly. So let's take, for example, someone who has an amount of money, whatever that amount of money is, and they want to make sure that their money is secure and can maintain its purchasing power. So your option is you go and you can invest in a 10-year treasury bond, or you can go out and invest in shares of PepsiCo. So going backward 10 years, owning a 10-year treasury has given a cumulative return of 12.73%. That's over 10 years.
Okay.
12.73% buy and hold. Whereas holding shares of Pepsi, you got a nice dividend that competed very effectively with the interest rate on the treasury bond. But if you reinvested that dividend plus the capital growth, Pepsi shares went up 167.3%.
Wow.
Compared to 12.73 for the bond.
Good example, good illustration, yes.
So it makes more sense to hold defensive companies than to hold bonds. For if your time frame is 10 years, and the truth is, people don't know what their time frame is. We have this conversation all the time.
We don't.
No, because they say, well, I'm 80 years old. Well, Warren Buffett's 93 and Charlie Munger died recently at 100. Right. So, I mean, what once again, going back to my original client, dying tomorrow doesn't matter. It's
right.
If you live too long, that matters.
If you live 20 years beyond where you think you're going to live, that's where it begins to matter.
Yeah,
but guys, but there are a lot of people who would say, and I think reasonably they would say this, hey, look, I'm not going to continue, Alex, to live on $200,000 a year when I retire. I'm going to cut back.
Yeah.
I'm going to live on less.
Mm-hmm.
So what's your response to me sitting in your office going, hey?
Oh boy. Oh, Bill. One of my best friends has had that conversation with me one time, and I tried not to jump down his throat, but I gave a very strong opinion. And generally speaking, and we just presented recently to a group of prospective clients, and we said the exact same thing: is you don't know. Maybe maybe you're gonna need less money in retirement. Maybe not. Probably not, and as a matter of fact, and there's a number of reasons why. So first of all, people are living longer. So actuarial studies conducted in the last 10 years found that a 65-year-old couple, there's at least a 50% chance that one of them lives to 94 years of age. 25% chance that at least one of them reaches 98. So
Wow.
that's 30 to 33 years, or 29 to 33 years of income that you have to sustain in retirement. So that's number one. So longevity is a concern.
Yeah.
Number two, what are you going to do in retirement? You're going to sit on your hands and watch TV for 24 hours a day, or are you going to want to enjoy your life? We talk about living your best life on this podcast.
Sure.
You work your rear end off for the majority of your adult life. You make a lot of sacrifices. Are you not going to want to enjoy the fruits of your labor in retirement? So you want to go out and eat out more. You want to travel. You want a cottage or a vacation home. You want to go out and enjoy more entertainment, whatever that is, concerts, sporting events, what have you.
You've got time, right?
Yeah,
You've got
you've got time, but all of those cost money. And so you need to have resources for that. You want to join a social club, like a golf club, costs money.
You want to go to
One
Chavez
thing,
Ravine to watch the Brooklyn Dodgers.
there you go. If you live in LA,
Those guys have a lot of money, by the way.
Mhm. Listen, Shohei ain't coming for free. Anyway, that's a separate discussion. But anyways, but another one that we get into is a lot of people. The reason why they think, oh, my expenses are going to decline, is they say, oh, well, my children aren't going to be living with me anymore. Maybe. First of all, a lot of adults, a lot of retirees like to help their grandchildren with some expenses like
Of
saving for
course.
their
Yep.
education. So that's another expense. But in terms of their adult children moving out, in Canada at least, 35% of adult children under the age of 34 are still living at home. We have a housing crisis here, and to a certain extent that exists in parts of the United States as well.
Yeah, it does.
And so you are having adults living at home for a longer period of time than we have seen historically, and that creates financial burden. 91% of Canadians say they provide financial support to their children. 91%.
Wow.
So even if your child isn't living at home, there is a very good probability that you are going to be supporting them to some extent. And so that is a huge expense that people don't seem to account for when they say my cost of living is going to go down. And the third one, and the most important one, and I can't underscore this enough, the last 5 to 10 years of your life can be the most expensive and are most likely to
Oh,
be the most
yes.
expensive.
Oh, yeah.
You
That's
know,
where I had a doctor underscore this to me one time when I was in his office and I was having my annual physical and we were just talking about medical costs and things. And he said, people don't realize that the most money they will ever spend in their life is concentrated in the last 5 to 10 years of their life.
Yeah.
That's where all the money that gets spent
Yeah.
in terms of, medical cost and, long-term care
care
and
homes, yeah,
everything else.
absolutely. Yeah, it's incredibly expensive. We saw it with my grandmother towards the end of her life. Unfortunately, she got to a point where she needed care in her home, and the cost can be astronomical. While none of us hope to suffer from declining health at the end of our lives, the reality is that a lot of us will, or many of us are going to experience that. So even in Canada, and obviously if you're living in the United States, take my numbers and reduce them 30% to account for the currency difference. But if for 4 hours of care, in-home care, it's going to run you in the neighborhood of $60,000 a year. 60,000. That's just
Oh,
for 4
I don't
hours.
even think you need to make that adjustment. I think that's a good number to work with here in the States as well. No.
There you go. And then you start getting into long-term care facilities, anywhere from $72,000 to $120,000 per year. That's huge money. For
Huge
some
money.
people, that may be more money than they earned in their during their career, and then they got to be forking out that much on an annual basis just to live. Like, I understand you expect, my house is going to be paid off and my kids are going to be gone, and so a lot of my major expenses are going to be off my hands. And like I said, maybe, but maybe not.
Maybe not. No, it's a matter of fact, John. So as we get ready to wrap this up, I mean, do you want to put a button on what Alex was saying there?
Yes, and if you have a dog and he gets old and sick, there's
no, that's real.
There's even more money.
It's real. Oh, yes, it is.
Yeah. So you know what? Life is not cheap. Life is expensive. Life is unpredictable, and you can never have enough. And I think there's a famous actress who said that back in the 60s, that you can never be too skinny, or you can never have enough money. If you
be too skinny or too rich, there's no such thing.
Yeah. Anyway,
you can't live on. You don't want to live on the margins, because you can end up getting burned. If you try and keep, play things too close, and unexpected things always happen.
Yeah,
True.
you just the world is just too unpredictable. You need to constantly be vigilant. You need to invest wisely. You need to invest productively, and you can't coast. And once again, I don't remember who said this originally. It could have been Lee Iacocca, but your lead, follow, or get out of the way in business. If you're not moving forward, and if you think you're going to coast and stay static, no, people are around you are moving forward. So that means you're moving backwards.
Yes.
And so you cannot stand still. You cannot coast. You always need to be looking ahead, and you always need to be moving forward, and moving forward as quickly as you can, or you're going to be stampeded by the crowd.
Yeah. I hate leaving on that note, but if you don't want to be stampeded, get in touch with these guys. Let's do it that way. Be proactive about it. We've mentioned before in past episodes that your contact information is in the show notes, but John, just before we get out of here, if somebody wants to reach out to you, what's the best way to do it?
Medwealth.ca is our website. That's www.med-wealth.ca. Or you can give us a call at 905-568-2000.
Excellent. Gentlemen, thanks so much. It's been a two-part series. For those of you who missed the first part, go back and listen to it. It's navigating the risk on the road to retirement. It's a good conversation, and it's a very real conversation, as a matter of fact. We hope you've enjoyed it. We hope you found it interesting, useful, as a matter of fact. If you're not a subscriber already, please hit the subscribe button. And that way, every time these guys drop a new episode of Prescribing Prosperity, you'll be notified. You don't have to think about anything about when or where you heard it. It's just there for you. And if you like it, we would ask that you rate this podcast and share it with other people. Get the word out about Prescribing Prosperity. Until next time, I'm Bill Tucker. On behalf of everybody at MedWealth Financial, thank you for listening. And I'm reminding you that you can go out today and make today a great day. Or not. It is your choice. Until next time.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information, or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests, and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.